It took me 20 years to buy my dream home. 20 years. That's how long it can take to achieve what you really want. Property is not a short-term game. It is a long-term strategy. Over the past 20 years, I have gone through different stages and executed different strategies at different points in time to help with this ultimate goal. When I was 15 years old, both my parents lost their jobs and we lost our family home. It motivated me to take control of my financial future. And just last year, me and my family were able to purchase our dream home, our family home, outright for the first time in Sydney. Now, it took me 20 years to achieve that goal. And in this video, I want to share with you every step, every action, how much income I made, what properties I purchased, when I purchased them, what I did, how I financed it, why I did it, how I pivoted, when I sold, why I sold, when I went fast, when I went slow, how I responded to different market conditions, every single move that I made over 20 years to achieve this goal. I hope you find it useful. Let's go. So property investing over a journey like this has different stages. You don't have the same tricks, the same formula at different points in time. That's something that you're going to pick up in this video. I'm going to go through my 20-year journey and you will see me change, pivot, adjust. We're going to talk about the strategies that I had at different points in time, how I adjusted my financing strategies, when I sold, when I bought, why I sold, why I bought. You're going to go through all of this. And it's something we've been doing with our clients at Alaya recently, going through property strategy. And one of the fundamental things that I talk about here is unpacking that at different points in time, you have different outcomes and different strategies. It doesn't need to be a one size fits all. That's something that you might be sold to a little bit because providers generally stick to one formula. But what I found for my own journey to achieve this outcome of buying my own home is that I needed to pivot at different points in time. So let's start right at the beginning for some context. 2005, I was 15 years old. It was 20 years ago. And at that time, something happened to my family, a little bit unfortunate. We lost our family home. Both my parents lost their jobs in the space of a year, and in that year, we stopped being able to pay our mortgage and really pay our bills at all. It's pretty hard to make life work when you're not earning an income and you've lost your jobs. At that time, I was just simply a kid experiencing some of the pain and hurt of both my parents losing that dream house that they worked so hard to go and get, and their lives kind of falling apart a little bit after that actually happened. I was just a kid, I didn't know how to solve the problems, but I knew right then that I would not play victim to my circumstances and I would take control of my financial future. And that's why I've listed it here as the starting point. I took control of my financial future. I was 15 years old, I didn't really have many finances to take control of. Truth be told, I actually earned nothing and I probably cost my parents a little bit of money to actually live, breathe, and eat. But at the same time, that desire and knowledge kicked in. I started spending time learning about how to do things, and this is where learning began. And you can do this before you are ready. You might not have any money. You might not be ready to invest in property, but you can start your learning process and your education. For me, something really, really amazing actually came out of this relatively bad experience my family went through. I found out what my passion and my purpose was very, very early in life. And it's why I'm standing here right in front of you. It's why we produce so much content. It's why we have this podcast. It's why I've partnered with Adi. It's why I run a mortgage broking business. It is because I want to help everyday Australians make better money decisions. It's a very, very clear objective that I have. It is what I will be spending my whole life trying to do. And that purpose began in 2005 from that experience. I can fast forward a little bit of time now to the year 2011, 2012, around then. I was 21, 22 years old, and I got my first job. The reason why I mention that is because when you first get your first job, you have now got the first ingredient that you need to even concept property investing. You need to earn an income. Unless mum and dad are going to give you that property and you're one of the very, very lucky Australians that can find a way to buy a home without taking on a mortgage at all, you need to earn an income to go and buy a home, especially an investment property when you first begin. So that's my first step. So many of you will be in a situation like this or have done this before, going and working and getting your first job. That was the year 2011 for me. And then it took me a couple of years to save up the money that I needed to buy my first home. So 2012 was the year that I got my first job as a graduate at Treasury. This is job. The job was my starting point to thinking about property investing, because in 2014, 2 years later, 2 whole years, it took me that long to save enough money to buy my first home. I had saved around $35,000 in deposit funds. So 35 grand is what I needed to go buy my first home. I scraped, I saved, I worked second jobs, I tutored around. I had to scrap and find my own way to get that deposit that bought my first property. But this is where it's really important that you take action with your deposit. With my $35,000, this is where I bought my first investment property. Let's break this down. I bought my first IP here. How did I do it? I had 35 grand and that wasn't enough money to begin with for the first property that I was actually purchasing. I bought for around $360,000 in Sydney. But because I hadn't quite saved up that money just yet, I bought an off-the-plan property that was actually going to complete in about 6 to 12 months' time. Now, this goes against the advice that you'd hear everywhere. And I'm telling you, don't go and do that in most circumstances. The thing that I purchased was more of like a house and land. It was a duplex that was being constructed and was nearly finished and was going to take another few months to finish. And in that time, I was able to save an extra 10 grand, which is what I really needed to go and complete that purchase. And that's why I went and did it. But here's the upside of purchasing a property like this, a higher risk property, a property investment strategy that I wouldn't recommend to anyone today. But the upside back then was it allowed me to save that deposit, but it also allowed me to be in the market. One of the key advices that I say to people, be in the market without actually putting all my money down. I'd only had to put in like $10,000 as the deposit for it, and it gave me the full exposure to that market cycle of that property. And that is why I did it, because I didn't have the money. It was a riskier property strategy that suited my circumstances at the time. So I had bought this property in Sydney for $360,000. And here's what happens when you start taking some action. You can get lucky. And that's exactly what happened to me. I got lucky. I was a kid just working things out. I didn't know what I was doing. I just parked some money in Sydney, and truth be told, I'd probably parked it there because I had driven past it and I knew the Sydney market, and I read everywhere, hey, Sydney's going to do well. It was a time where I think rates were coming down, and the broader macro story was, hey, assets are going to do well in this period. And I bought in Sydney, and this is the crazy thing. I bought in like March, and by the time December rolled around, when I could actually settle on the property, I didn't settle for $360,000. I had settled for about $460,000, which is crazy. I paid $360,000 for a property, but it was worth $460,000. I know that makes no sense, and that's where the luck component happened. And this is why it really suited me at the time, because I didn't have that deposit, and it allowed me to get in a rising market with a very small deposit, and I had made roughly 100 grand in equity straight away. And this is what I did with this 100 grand. I took it straight back out. I took about $90,000 out with a 90% loan of this equity that was there. And with this, I had bought another 3 properties as quickly as I could. So I bought 2 in Brisbane, and from memory, I had bought another one in Sydney at the time. So I had bought 4 properties really, really quickly from my one deposit. I'd saved 35 grand, but then I ended up with 4 properties because the first one I'd purchased had gone up. I'd stripped out the equity, and then I used this equity to go buy 1, 2, 3, and 4, and I had my foundational properties inside a year. Awesome. So what I have done here is set my foundations. This is key. what I'm looking for. Now let's unpack the lessons in all of this and some of the lessons you want to take away. Everyone's going to have a slightly different approach to this, different stories, and I'm not saying any of these assets were good purchases. In fact, I made a lot of mistakes at this point in time, and these assets weren't actually amazing investments that I'd purchased. They were suited to what I wanted at the time, but they weren't really great properties, and I'll go through exactly what they were in a different video. But what I did was take action. Importantly, I had stretched my $35,000 cash savings into, I think the total investment here was around 1.2 million. So I'd got an extra $90,000 here. I had a $35,000 deposit saved up, so I had roughly 125K. I got a $1.2 million asset base, but I had only put $35,000 down. So what this meant was my little tiny savings as a proportion was being extrapolated into a much, much larger asset base. At the time, it was very easy to get money. The banks were just giving it out the door, and I leveraged my income stream that I was earning into assets. So this is one of the attitudes you might want to take on, is your income is a stream to leverage into assets. It sounds crazy. Your income, that is, you go to work. Why was I going to work? It was simply because I needed a stream of money, of income that could be used for the banks to give me the leverage that I needed to go and invest in assets. So that's my starting point and how I built my foundational properties. I started by saving some money, scraping my way there. I took a few risks. I found ways to accelerate it. I worked second jobs. I did a little bit of sports betting from the time as well to just kind of accelerate and make it a little bit faster. Did whatever I could. Thank you, David Warner. You scored a century on debut, and I still remember that because I won a little bit of money that day. And you have yourself a fan because of that. That helped me increase my $35,000 quicker. How did I get here? When I was working, I worked, I saved, I took on risks, I tutored a little bit. Wherever I could earn a little bit more money and wherever I can cut back on expenses, I did, because I knew that I needed to scrape my little way there and come up with some savings. I got myself a job to start it. Found my savings through some creative methods and just the standard ones in terms of saving your money. And with that, that's where it started kicking off. I got a little bit lucky. There's no denying that. I bought and I made a quick 100 grand, which is, possible to do now by buying in the right markets. But that really, really helped me get this foundational set up. And importantly, I took that money straight back out, bought a few more assets, and that got me on my way. Okay, so now I'm 25 years old. It's been about a decade since that boy, that teenage version of me, decided I'm going to take control of my financial future. And I have started taking some action. Take those little takeaways away if you're watching this. Have that first step. Take action. Be in the market. Don't just let it run away with you. This is risk-taking that you need to start embracing if you want to become a portfolio investor. And if you're a young person trying to get into the market as soon as you can. There's so many wonderful stories out there. I love going on my Instagram, TikTok, seeing all the great people starting out their journeys, documenting it, being like, I'm purchasing property, I'm making it work, I'm taking control of my financial future. It's not an unusual story at all. I'm just going through my journey. I'm 25 years old at this point. This is where I take one of my first big risks. This is a big decision for me at this time. I have now gone to the year 20. Let's keep this time frame here. We flipped the board. We had to delete it because it didn't fit. So we are at the year 2015 and I begin my business. So I'd worked out that my goal was to buy myself a dream family home, which is really the title and the whole story of this video. But I had also worked out buying myself a family home where I wanted to buy my family home was going to cost me a fortune. I live in Sydney. I grew up in the western suburbs of Sydney, but I fell in love with the most beautiful woman that I had met, and she lived in the eastern suburbs. And I wanted to provide and give a life to her that she had grown up with, and I wanted to be able to do that by myself. Now, she didn't need any of that. She didn't ask for any of it, but I just wanted to be someone that was worthy of her. I know that sounds really, really silly, but that's how I felt at this time, and I was quickly worked out, hey, she's the woman of my dreams. She's grown up a certain way. I want to be the man that can provide her everything that she wants. So I quickly worked out that that was not going to happen in the job that I was in. I know it sounds a bit crazy, but that's part of the reason why I began a business. I absolutely loved my job, but it wasn't really in line with that big purpose that I had, which was about helping people with money. So I began Confidence Finance, our mortgage business, now rebranded to Flint Invest. So I began Confidence Finance as a mortgage broker. So the lesson to take here is, if you want to achieve something a little bit outside the ordinary, and me buying a $5 million plus home at 35, that is outside the ordinary. I didn't get parental help for it. I found my own way to do it. That sort of outcome is outside the normal sort of outcomes that people go and achieve. That outcome needs to be followed with actions that are a little bit different. That's exactly why I quit my job then and I started a business. The upside of this, and something that is really, really important to go and know and really fundamental to my journey, and you don't have to follow this, but it worked for me, is be very, very good at what you do. It makes things so much easier, especially when you operate in a business and then you become very good at it. In my own business, in my own career, in 2015, I began my business. By 2016 and 2017, I was already one of the best in Australia at what I was doing. That was a bit crazy. I didn't expect that level of growth to begin with, but I became a mad nut. I was like, I ran a business, I'm gonna get good at this, I'm gonna get good at my craft, good at my trade, learn everything that I can and share that with the world. And Confidence Finance done really, really well, and my business took off. That's the truth. And that's also something that no one actually talks about. There's a truth to all of this. I've achieved that big lofty goal, that $5 million home at my age. It happens by increasing my income, which is exactly what I want you to take out of this. Increase income. This was the trigger point to my ability to increase my income. And my income looks more like this year on year. This is the year, 2011, and this is 2015, and this is 2020. It was increasing at an increasing rate, and at 2025 it keeps rising. I was running a business, getting good at it, and building that business. That's what happens when you're in something and you have the focus of not just cutting back expenses, it's increasing your income too. That was my goal, and it's something that I went and did. I feel like a lot of people are afraid to say it, and yes, I'm gonna cop some heat for saying that, but it's the truth. People who have goals like this or have 10, 20, 30, 40 properties that they don't say, they have high incomes. They run businesses, they earn incomes, they focus on increasing those incomes, and those incomes fuel their portfolios. So if you hear somebody say, you're going to retire from property by copying me, X, Y, and Z, that may not be true if they're not telling you this very, very fact, that they are running a business and they're earning a higher income than the average Australian through that process. And that would have been my story. I don't actually have the math here, but I can probably share it, where it's just like my income at the time. Unpacking it at the time, I began a grad job. I probably earned 50K. When I left that grad job, this is 2011, 2012. In 2015, when I began the business, I was probably earning 90,000. And in 2018, I was probably earning 300,000. At the time as a 28-year-old, doing fairly well, and then income kept rising from there. It probably doubled another once or twice over. I know that sounds crazy, but running a business and doing it well has helped me earn a very large income over time, which has fueled everything that I'm about to go through next. So the reason why I'm sharing this is because increasing income was the attitude that I had. And yes, I got lucky. Some of this was definite luck, and it was situational, and I had timed it at the right time. There was a property boom going on, interest rates were lower, etc., etc. All these things outside my control were taking effect. But the things that were inside my control, I was doing everything I could to actually empower myself and increase my income. And all this income increase goes back to the previous lesson. My income was a stream for me to leverage into assets. Because I knew that, I worked on increasing my income so I could increase the amount of assets that I had, so the compounding effect of all of the assets that I had could continue to grow at a faster rate. Okay, so now that I've increased my income, it's so much larger than what it once was when I was investing. At this point, 50, 900,000, I was earning multiples of that, 10 times that really. At this point in 2021, 2022, after COVID, I was earning significantly more than I had begun. So my property investing strategy needed to change too. At this point, in my foundational assets, I didn't go into it specifically because I didn't want to steer you in that direction. I didn't go talking about the assets that I purchased because that didn't actually help the story. The fact that I took action did. The assets I purchased were yield assets, things that gave me cash flow. That is, that put money into my pocket every single week. In fact, each of those property investments that I had, the 4 that I had to begin with in my foundational assets, each of them put roughly 10K into my income, which meant that I was earning an extra $40,000 in the year 2015 when I had first began my business. The reason why I did that was I had known that I was going to start a business in and around 2013, 2014. When I figured it all out, I'm like, I need to be in business. One thing that happens when you go in business and you don't have parents just throwing money at you is you need to find a way to actually get your income there. This was my risk protection strategy. I was using property, yes, as foundational assets, but I was also using it to generate income. So if my business wasn't going there, I could actually eat and survive and pay rent and not be kicked out on the street and being like, oh crap, I've really stuffed this up. I was actually playing defense a little bit. So sometimes you'll be buying assets around your circumstances. A lot of people buy commercial properties for this very purpose. They're playing a little bit of defense sometimes because they want that yield in their property portfolio. And early on, a bit different to everyone else, I needed to play defense because I was going to do this before I went to offense mode, which is exactly what I'm going to go through next. Okay, so now that I had increased my income, it was time to shift gears with my property investing. And this is exactly what I did. So this is where it starts looking a little bit different to other people. But the idea here was I wanted to build wealth. That is what I needed. My end goal here in 2025, by 35 years old, I wanted to be buying that dream home of mine, and I knew it was going to cost me a fortune. That was the end goal. To achieve that, I needed wealth, but I had only got cash flow assets. This was not going to take me here. I knew that very closely. The income would obviously help, but I don't want a giant mortgage when I bought this dream home because it is a luxury buying this sort of dream asset. I didn't want a big mortgage. I wanted to actually be able to buy it outright cash if I wanted to and not have any big loan against it. So this is where my property strategy pivoted. It was roughly around 2019 to 2025 in that sort of time period, but this 2019 to 2022 period, this 3-year period, it was party time. It was time to go pedal to the metal, play a game where I'm effectively going need for speed, and it is time to hit accelerator on that pedal and go as fast as I could. I knew that the market was moving. I knew that was a golden opportunity. I could feel it in the business. I could feel it with all the clients that we're working for. And then I shifted my property strategy to wealth creation. This is something that not everyone talks about, but I really believe in the velocity of your returns. So let's use this concept, velocity of returns. Now, most people do not associate property as the vehicle for velocity of returns, and that is correct. Property is not the vehicle for this. But what I had invested in was really good quality land assets all across Sydney that were being rezoned and had planning changes associated with them. So I've done a couple videos here. Here's this really good one where I go through a few of the deals I actually took place in and around this time period inside short windows and made a lot of money doing so by executing individual deals that were benefiting from Sydney's rapid rise in house prices during this time period, the market movement, as well as buying assets that were a little bit undervalued because the market couldn't quite work out what you would do with this, finding some ugly ducklings and being like, hey, it's not so ugly, putting some makeup on it and being like, yeah, it's really, really pretty. Do you want to buy it now? That's effectively what I did. And there's so many different property strategies that you can implement to achieve the same outcome, velocity of returns. You can do renovations as one. That's a very, very common one. You can do developments. It's also something that I did in this time period. I did a few developments. And I had bought a couple juicy land assets that I still own today that were benefiting from change. So I bought a few land assets side by side, sort of houses that with granny flats on them that kept a decent yield in and around train stations that would be rezoned over time. And something that's a little bit unusual is everything that I had purchased sort of in this time window, by the year 2025, they'd effectively been rezoned and changed, and what you could actually do with them had changed too. And that had uplifted the value of the land during this time period. Now, most of Sydney, a lot of Sydney, anywhere near a railway station has been rezoned by now, but it was having the foresight and the planning to know that, hey, there's going to be some changes in and around. And in 2019, there was a round of changes. I'd benefited from that. And then in 2024, there was another round of changes. Again, I'd positioned my asset selection around some of the movements that were happening by tracking in those economic changes that we talk about. At Alaya, we talk about this a lot. And there's opportunities in Melbourne right now that exhibit the same sort of profiles. One where the market is rising a lot. The Melbourne profile could easily be 2025 to 2027 with this same sort of window of opportunity. Melbourne's the marketplace where if you want to execute something like this, it'll probably be Melbourne specific now. I wouldn't say do it in Sydney. The frameworks look a little bit different. So these are some of the things that I started doing. Go watch that video for the deal specific analysis of what I did. But what I had actually got was the velocity of returns. And that also meant that I was making money a bit quicker. And importantly, I was selling too. I sold, I paid my taxes, I paid all the agent fees, which meant money came out of my pocket, but it was realized capital. It was actual money that goes into your bank account from buying assets at one price and selling at another. Because of doing that, I'd increased the amount of deposit that I had available, and that helped me buy my own home. During this time window, I'd executed a whole range of deals. We built around 10, 12 homes, did 3 or 4 development sites. We had bought and sold a number of assets. We had got really, really active in the Sydney property space and made myself some money backed by the income that I was earning at the time that allowed me to take on more risk. Doing all of the income helped the risk taking here, and some of that risk taking helped increase the wealth that I had for me to go and purchase my asset that I actually wanted. Okay, so what did I do next? This is around last year, 2023, 2024. I did something that I needed to do. And this is where it looks a little bit different to everyone as well. I had a couple young kids at this point in time. 2020 was the first year where my daughter was born. I became a dad, best year of my life. 2022, my next daughter was born. Everything changed for me and my family. It became crystal clear that this bigger dream that I had was in eyesight. I knew that I was close, that I could go and do it. And in this time as well, I had bought an owner-occupier. Me and my wife had lived in a family home. We'd bought an owner-occupier. We'd even upgraded it once, but it wasn't the dream home that we wanted to live in. That was something that helped us on our journey too. But in 2023, 2024, that's when we started making strategic moves for our plan in 2025. Or we actually purchased the asset last year. So it was in and around here where we started selling. Now, this wasn't about market timing. It wasn't about, the perfect time in the market to sell. It was about what we actually wanted and about structuring it correctly. Now, before I go into this, I want to tell you about how I funded this little period in time and the financing strategy here. So financing in this period that I was in looks a little bit different to the financing when I first began in 2015. I'd started using companies, I'd started using trust lending, I had got very aggressive with my lending and financing approaches and got far more sophisticated in the structuring and setup of how I did it. Now, If you could do me a favor, I'm actually a little bit unsure as to which part of this video you want me to go into in a little bit more detail. Is it the financing structures at different points in time? Is it what I purchased? Is it the business? Is it my initial investments? Drop a comment below and just tell me, hey Redem, I wouldn't mind if you did another video on your 2019 to 2022 period. Hey Redem, I don't like you very much. I really like Mortgage Brokers doing well, so go stuff off. You can probably put that in the comments too. I don't mind, that's okay. It'd be a bit strange if you're watching this and commenting that, but if that's what you want to do, go do it. You're welcome to. So here we have our financing strategies in 2019, 2022, companies, trust. Everything became far more advanced. Now, I notice nowadays that so many people are going to watch this video and be like, I'm going to do what Redem did in 2019 to 2022 without doing all the things that he did beforehand and just skip to the end being like, this is where he did really, really well. So let's go to companies, trust. Let's go be very, very complicated. Let's go to developments. Let's go to rezoning strategies when they haven't even bought an investment property. The truth is confidence grows, attitudes change, and your learning and knowledge base adjusts over time. And all of this was being done with a very high income supporting me. You take different decisions at different points in time, depending on where you and your family are at. That is something that I'm repeating repeatedly through this message. Right now, I'm doing these property strategy sessions with Flint Invest and Elia clients where we run through exactly how to achieve what you want, the end goal, and how individual assets at different points in time and their locations and what they are actually doing as a tool to get you where you want to get to, much like this journey and storyboarding how to get there. And one of the key themes that I keep presenting to everyone is it looks different. And your financing strategies look different depending on where you are and what sort of income you have at that point in time, and interest rates too. So it's always about being flexible, being communicative, and adjusting as time changes. So 2023, 2024, I had sold a whole range of assets. I had sold over $10 million in assets and realized a few $1 million in capital as a result. A couple development sites got sold. I just sort of offloaded as much of the stuff that I didn't need for what I wanted. And with the proceeds of this and my income, I was able to go buy this home for me and my family. So there you have it. And this is the broad story, a bit of a mix of assets, a mix of decisions. I had sold a whole bunch of properties. And when I had first began in 2019 as well, I had sold all 4 of these investments that I had first purchased and got rid of them because they were not supporting the goal that I had in mind. I was not afraid to pivot, change decisions, sell what I didn't need because it wasn't helping me get to my goal, then change my strategy, get really aggressive at the right time, slow down at the wrong times, and then actually take money off the table because it was to the bigger goal that I had. Going forward, you're gonna ask me, hey Redem, what are you gonna do next? And the truth is, I don't actually know. This has been my big goal for a long time, and going forward, my simple goal is to just help educate others about what to do next. And once this home's paid off, I'll probably go invest in property because it's what I know, it's what I love, and it's what I have access to as well. So I'll keep doing that. But this was the ultimate goal that I had, and it's something that we were able to achieve recently. At the end of the day, I'm just a Bengali boy that was supposed to grow up in one of the most underprivileged, poorest communities in the world. Instead, I was lucky enough, extremely fortunate, and very, very thankful to the very parents who I talked about in the beginning of this video. That thankfulness, that gratitude has been absolutely core to my journey. Grabbing the opportunities that my parents gave me, that this country gave me, that my friends and family and my community here on this YouTube channel have given me. I've been trying my best on this channel always to share everything that I know so you can make better money decisions. Now, the point of this story isn't to brag and show, hey, I own a nice home, good on me. That really wasn't the value that I'm trying to provide here at all. I'm trying to share how I actually do it and inspire someone listening to this video to take some of the actions that they need to go and achieve whatever goal that they have. At the end of the day, everything this channel is about helping you make better money decisions. From all the suburbs we talk about, the research we present, and everything that we do. And at the core of this video, it's that very mission, to help you make better money decisions. Hey everyone, if you like this type of content, do me a big favor, hit that subscribe button and let me know in the comments below if this is the sort of content that you like. I will do more and more strategy sessions, whiteboard sessions, and it won't just be my life that I go through. I'll go through some of our clients and the journeys that our clients are going through step by step to go and achieve it, if this is the sort of content that hits home with you.